Hello friends, this is our 12th video lecture and it will be about IAS 16, Property, Plant and Equipment. So, definition of Property, Plant and Equipment, or PPE. Property, plant and equipment are tangible items, which means items which have a physical form. These items are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes. These items are also expected to be used during more than one period. So, items outside of scope. Next item are in line with in IAS 16 definition of PPE, but outside of scope of IAS 16. Investment properties IAS 40, property, plant and equipment held for sale IFRS 5, biological assets IAS 41, and mineral rights and mineral reserves, for example oil or gas. So, initial recognition of PPE. The initial measurement of PPE should be carried at cost. This cost includes purchase price, but this purchase price must be adjusted. We need to add any import duties, we need to add non-recoverable taxes, and we need to exclude any discounts and rebates. Any costs directly attributable to bringing the asset to the location and condition in order to be ready for use are also included at the initial recognition cost. So, for example, any examples of directly attributable costs are costs of site preparation, initial delivery and handling costs, installation and assembly costs, testing costs, that's actually costs to check that asset is functioning properly, professional fees, costs of employee benefits arising directly from the construction or acquisition of the item of PPE. Examples of costs that shouldn't be considered directly attributable. And if they are not directly attributable, they also shouldn't be included in the initial costs, shouldn't be included in the initial cost. So, examples of such not directly attributable costs are administration and other general overheads, startup costs, that's for example costs to open a new facility, survey costs or costs in order to study whether to invest in the asset or not, advertising and promotional costs or costs in order to introduce a new product or services, and staff training costs. So that's actually examples of costs. These are examples of costs which are not directly attributable and shouldn't be included in the initial cost. And the initial estimate of the cost of dismantling and removing the item and restoring the site on which it is located. Such costs should be included in the initial cost of recognition. So, if there are any costs of dismantling and removing the item and restoring the site on which it is located, we need to include it at the initial recognition cost. An item of property, plant and equipment should be recognized as an asset only if its cost can be measured reliably, it is probable that future economic benefits associated with the item will flow to the entity. So let's discuss capitalization of expenses. During usage of property, plant and equipment item, there could be repairment costs. The cost of small repairs and day-to-day maintenance should be taken to profit or loss in the same period as these costs occurs. Expenses which require capitalization are expenses which enhance the economic benefits provided by the asset. This may relate to extending the asset's useful life or increasing its productivity. Expenses which relate to an overhaul or, for example, big repair or rebuilding of the asset. Expenses which relate to the replacement of major component of the asset. So such costs, that's actually examples of expenses which must be capitalized. So, major parts. Major parts are parts whose cost is significant in relation to the total cost of the asset. In accordance with IAS 16, major part of the asset must be identified and depreciated separately. Borrowing costs may be capitalized too. This is regulated by IAS 23 borrowing costs. Let's just here a small mistake. This is regulated by IAS 23. So we have already reviewed IAS 23 borrowing costs, and as you probably remember, borrowing costs attributable to qualifying assets should be capitalized. So let's move further, and let's start our discussion of depreciation. So what is it? What is depreciation? Depreciation is a systematic allocation of the depreciable amount of an asset over its useful life. Useful life is a period over which the present owner of the asset expects to derive economic benefits from it. Depreciable amount is the cost of an asset less residual value, and residual value is the estimated amount obtainable from the sale of an asset at the end of its useful life. So, depreciation methods. There are 4 depreciation methods: straight line method, diminishing balance method, sum of digits method, units of production method. So, let's look at the example for straight line method. The straight line depreciation method charges the cost evenly throughout the useful life of an asset, and the formula for this method will be the next. Annual depreciation equals cost minus residual value divided by useful life. And here we have an example. Our entity, Fluffy Kitten, purchased an item of equipment on 1st April 2017. This item was put into operation on 1st May 2017. Equipment will be used for administrative purposes. Please see next details. Purchase price, we have $1,400. Also we have residual value. Our useful life is 10 years, and we need to calculate monthly depreciation charge and depreciation charge for the year 2017. So we need to prepare journal entries. Also, we need to prepare journal entries. First of all, we need to calculate monthly depreciation charge. So we take our cost minus residual value, which is 1,400 minus 200, and divide it by useful life in months, which is 10 years multiplied by 12. So it gives us actually a depreciation charge of $10 per month. Yearly depreciation charge for 2017. We have our monthly depreciation charge, and we have a period of 8 months for accrual of depreciation. Why 8 months? Because our item was put into operation on 1st May 2017. 1st May 2017. And which means that till the year end, 31st December 2017, it's actually 8 months period. So that is why, in order to calculate depreciation for 2017 year, we take our monthly depreciation charge and multiply by 8 months, which gives us $80 per year. Monthly journal entry will be for accrual of depreciation, debit administrative expenses of $80, credit accumulated depreciation of $80. So, let's look at other journal entries, which also must be made. So, at the date of purchase, we should debit our account for capitalizable assets or for capitalization of assets which are not ready for use. First of all, that could be different entities can have different names of such accounts. That is why several examples here. So we debit, for example, construction in progress or a capitalizable assets account for the purchase price of $1,400 and credit our accounts payable for the same amount. If the payment was made at the same date, we debit our accounts payable for purchase price amount and credit bank account for the same amount. As you remember, on On 1st May 2017, the asset was put into operation, which means that we need to debit our equipment account. Asset is ready for use and is going to be used starting from 1st May. So on 1st May 2017, we debit our equipment and credit our construction in progress and or capitalizable assets or any other name for the relevant account which is used on the entity for the same amount. So, another example we have diminishing balance method. That's another method of depreciation. This method is usually used when economic benefits from an asset are expected to decline over time. According to this method, depreciation charge is high in earlier years and lower in later years. So the formula will be annual depreciation equals carrying value times depreciation percent. So let's look at the example. Our entity Fluffy Kitten purchased an item of equipment. Please see next details. So purchase price we have here, residual value, also useful life of 5 years, and diminishing percent of 50%. And we need to calculate depreciation during useful life using diminishing balance method. So let's try to calculate it. So depreciation charge for the year 1 will be carrying value multiplied by depreciation percent. Carrying value of 2,400, which is purchase price here. We don't need to adjust it for residual value for diminishing balance method. So we just take our purchase price and multiply by the percent of 50%, and which gives us depreciation for the first year in the amount of $1,200. Depreciation charge for year 2. The carrying value will be our purchase price minus depreciation for the first year and multiply by 50%, which gives us $600. The same situation will be for year 3, but here we need to subtract depreciation for 2 previous years, and the result will be $300. And as you can see, the situation is the same for years 4 and years 5. And if we just sum up all the depreciation charges for all 5 years, so it will give us $2,325 if we just sum up this one, and this one, and also these two. We have 2,325. A little bit messy, but it gives us $2,325, and as you can see, residual value $75. So that's correct. As you can see, we have at the end of the 5th year residual value of $75 because our purchase price, our initial cost $2,400. Here, sorry, that's a 0. A little bit messy, I'm sorry for this, but just to, oops, sorry, that's 0.2 minus, and we have a residual value of $75. So let's move further. And sum of digits method. So sum of digits method is an alternative method to diminishing balance method. It allows to charge higher depreciation in early years too. It takes the number of years left to use and divides them by sum of the years. Hence, in the earlier years depreciation is higher. So the example is almost the same. We just don't need here diminishing percent to use for this method, so we just ignore it here, and we need to calculate our depreciation using sum of digits method. So let's try to calculate it. Depreciation charge for year number 1 will be cost minus residual value multiply by years left to use and divide by sum of years. So we have our cost, we have our residual value, and we multiply it by years left to use. At the beginning of year 1 we have 5 years to use, so we take our 5 years and divide it by the sum of all years, so year 1 plus year 2 plus year 3 plus year 4, year 5, which gives us 15. And we also calculate the depreciation for year number 2. As you can see, the only difference is in year 2 is that the number of years left to use changed. It decreased by 1 actually. And the same situation is here in year 3, year 4, year 2 and year 1, so year 4 and year 5, sorry. So in year 4, for example, it is 2 years left to use at the beginning of year 4 actually, and year 5, and at the beginning of year 5 1 year left to use. So, and if you just sum up all these figures, you will receive the amount of $2,325 again. If you just sum up all this, sorry, a little bit ugly, I'm sorry for this, but just to show, if you sum up all this stuff, it gives you 2,325, and it means that we have calculated everything correctly, because the residual value equals 75, so 2,400 minus 75, that's 2325. And if we calculate our depreciation, it gives us 2325 accumulated depreciation, and our initial cost 2400, so 2400 minus 2325, which gives us 75. So let's move further. Units of production method. According to this method, the assets depreciation charge reflects the proportion of overall production capacity utilized over a defined period. Formula will be the next. Annual depreciation, depreciable amount, total capacity, divide by total capacity and multiply by units produced during the year. So we have the same example, almost the same. We have new details here. So as you can see, estimated production capacity 20,000 units over useful life. Production in years 1 till to years 3, 5,000 units per year. Production in years 4 and 5, 2,500 units per year. And we need to calculate depreciation using units of production method. So let's try to do this. Depreciation charge for year 1 will be, we take our cost, subtract residual value, multiply by produced items and divide by total capacity. So if you subtract here again 2400 minus 75, this gives us 2325. We have 5000 production of units in the year number 1, and divided by total capacity of 20,000, and it gives us depreciation for year 1 of $581.25. The same situation will be for years 2 and 3, because the production of units is the same, 5,000, and depreciation amount will be the same too. And in year 4 and 5, the formula changed a little bit. As you can see, the production of units is 2,500 here, so the amount of depreciation decreased. And here we have a rounding effect in the last year, just to receive our 2,325. So if you calculate this, sum up this and this, you will receive 2,325 actually, which means again that we have calculated everything correctly. So let's move further. So when should we start to accrue depreciation, and when should we cease accrual of depreciation? Depreciation of an asset begins when it is available for use. Charging of depreciation cannot be delayed even if the asset is not used in production. Depreciation ceases if the asset is classified as held for sale under IFRS 5, or if the asset is derecognized. So, measurement after initial recognition. IAS 16 provides two options for measurement methods after initial recognition: cost model and revaluation model. IAS 16 requires consistent approach to be applied to all the assets. Here a little mistake, we just cross it, which belong to a certain class. So examples of asset classes: land, buildings, machinery, motor vehicles, furniture and fixtures, office equipment. So that is just sample examples. Usually classes could be more detailed and more complicated actually, but that's just to show you an example. That's examples of asset classes. These categories can be split into smaller ones to form distinct asset classes. An important thing to note is that entity cannot follow different measurement approaches for the same class of assets, even if they are used in different geographical locations. So, if according to your accounting policies you use, for example, cost model for machinery, it means that you should apply cost model for all machinery items. You cannot just apply revaluation model for some machinery items. If you have chosen cost model for machinery items, you should apply cost model to all machinery items. And for example, if you chose an revaluation model for buildings, you should apply revaluation model for all buildings. So, under cost model, depreciation is accrued, and we have already calculated depreciation under several depreciation methods. Net carrying amount of the asset equals initially recognized amount minus accumulated depreciation. So, let's discuss in more detail revaluation model. Revaluation model is more complex area. One important aspect of the revaluations is the treatment of accumulated depreciation. According to IAS 16, accumulated depreciation should be handled in one of the following ways: eliminated against a gross carrying value of the asset, restated proportionally with the change in carrying amount. An entity switching from the cost model to the revaluation model is not required to adopt the changes retrospectively. Also, this is a change in accounting policy. IAS 16 provides a relief from restating previous year's balances. So, also, we just are going to look through several examples to understand it a little bit deeper. Let's look at the example here. Our entity Fluffy Kitten purchased some land for 15 million. It is accounted for under revaluation model. The external valuation expert perform assessment of land. At the year of number 1, the land was evaluated in the amount of 21 million, year 2 14 million, year 3 23 million, and we need to prepare relevant entries to reflect these changes. So, year 1, as you can see, there is a 6 million increase in year 1 from 15 million to 21 million. So, this means that we need to debit our land by 6 million and credit as a comprehensive income revaluation surplus by 6 million. Year 2, as you can see, there is a 7 million decrease here from 21 million to 14 million. So, in year 2, there was a 7 million decrease. This decrease must be recognized in profit or loss unless it reverses an earlier upward revaluation. And actually, in year 1 we have a revaluation surplus upward revaluation of 6 million. So we need first to reverse this 6 million. So we debit as a comprehensive income revaluation surplus by 6 million and then debit our profit or loss for the rest 1 million and credit our land by 7 million. So, and year 3. In year 3, as you can see, we have a 9 million increase from 14 million to 23 million. So, In year 3 there was a 9 million increase. This increase must be recognized in other comprehensive income unless it reverses an earlier downward revaluation. And actually in year number 2 we had a downward revaluation which was recognized in profit or loss of 1 million here. So we need to reverse this 1 million. So first of all we increase our land, we debit our land account by 9 million, then we reverse our credit, our profit or loss, we credit our profit or loss by 1 million to reverse previous year recognition in profit or loss. And then we credit our other comprehensive income, revaluation surplus, by 8 million. So let's look at another example. Fluffy Kitten purchased a machinery item for $100,000 with a 10 years useful life. Residual value is 0. 5 years later, when the net carrying amount is 50,000, the fair value is defined in the amount of 60,000. We need to prepare relevant entries in order to reflect these changes. So, as you can see, there is a $10,000 increase in fair value. So, we have a 50,000 carrying value and fair value of 60,000, which gives us 10,000 increase. So we debit our machinery by 10,000 and credit other comprehensive income, revaluation surplus, by 10,000. So also the remaining useful life of the machinery items is 5 years. Therefore the revised value of 60,000 should be depreciated over 5 years, which gives us revised annual depreciation in the amount of 12,000. So 60,000 divided by 5, we have 12,000 yearly depreciation. The difference between the original depreciation of 10,000 and the revised depreciation of 12,000 can be transferred directly from the revaluation surplus to retained earnings over the remaining useful life of the asset. So the accounting entry will be debit revaluation surplus 2,000, credit retained earnings 2,000. So that is the end of lecture number 12. Thank you very much for watching. I hope this lecture was useful. Bye.